My name is Michael Guyette, publisher of the Lead Lag Report. I was Mr. Michael Hewson. Mike, introduce yourself to the audience. Who are you? What's your background? What have you done throughout your career? What are you doing currently?
Yeah, good afternoon, ladies and gents. Well, I've been in the market a while, 30 years, doing various bits and pieces. Started out as a spot currency trader, trading dollar yen of all currencies, working for Commonwealth Bank of Australia back in the 1980s and 1990s. Didn't just trade spot, also did a little bit of Australian dollar depots, forwards and what have you in my time there. And got a real flavour, I think, for technical analysis. I know some of you won't particularly like it, and I know some of you will get quite a bit of stick for looking at squiggly lines on charts. But ultimately, I think it's really a matter of what works for you. And it really does work for me. Technical analysis, it allows me to manage my entry and exit points into trades. And I think that's important, not only managing stop losses, but also when to get out of a profitable trade. I think one of the common mistakes an awful lot of people make when they're trading is they think an awful lot about their stop loss, but I don't really think an awful lot about their take profit. And that is a lesson that I've been trying to hammer home to all of our clients at CMC Markets for the last 10 to 15 years. I started at CMC back in 2006, didn't originally start as a market analyst. I was working in product development. So one of my roles was to try and improve the charting package within the platform. And with my background as a trader and a technical analyst, I had a fair idea of what I wanted to see out of charts, technical analysis, risk management, and what have you. And my approach is a fairly simple one. I'm not into Elliott Wave. I think that's a load of old nonsense. I'm also not particularly big on RSIs and those sorts of indicators, simply on the basis of the fact that depending on the value that you use, you're going to get varying results. What I do is use RSIs and moving averages to complement the primary analysis of what the market is doing. So essentially looking at the price, the trend, support and resistance, and trend lines. It's no more complicated than that. I think there's a tendency as a technical analyst to try and sometimes make it more complicated subject than it actually is. And for me, it's a very simple subject. The market is either going up, down, or sideways, and you base your trading decision on your interpretation of where the market is going to go to next, and essentially then wait for the market to come to you. And hopefully, all things being equal, you'll manage your risk that much better. No, ultimately, that doesn't mean that I make money all the time. I don't. Some of my worst trades, I've lost an awful lot of money on. And that's where the importance of stop losses, I think, comes in very handy and is very important. So that's really me, I think, charting, technical analysis, currency trading, but also as part of my role here at CMC, I also talk about other areas of the market. So there's an awful lot of intermarket analysis going on, looking at equity markets, looking at bond markets, looking at commodity markets, and trying to join the dots in terms of where I think markets are likely to go to next. And I think Michael has his own views on that. I've been looking at some of his tweets, and he thinks that the markets are on the cusp of a major break lower. I don't necessarily disagree with that, certainly looking at some of the US markets right now. European markets, I'm slightly more sanguine about, but I'm guessing that's a discussion for this particular forum.
Yeah, no, that's great. And by the way, I was laughing when you mentioned the squiggly line. To be clear, I'm not anti-technical analysis. I just think that there's a lot of stuff that people reference that you can't backtest, patterns that don't really have any predictive power. There are certain things that do have merit when you actually look at it historically. All right. So, to me, it's more just sort of a commentary on the way that people tend to look at multiple lines as if it tells you anything about the future, and it could just be randomness. But there's actually a lot that I want to key off of based on what you just said. And I want to go full circle to how you said you started trading with dollar yen.
Yeah.
It does, because that's now the big news. Now, I am, to be clear,
my work. That is my worst call this year, by the way. I'm going to put that right out there right now. When it was 135, I said at the beginning of the year, dollar yen's going down to 120. And look where it is.
That was one of my... You're not over, in fairness. But hold on, I do want to tease this out because this has been a thesis I've had for a few months, that there is a possibility of let's call it a global margin call sparked by a reversal of the carry trade as the yen keeps weakening, as the BOJ gets forced to act, especially because of oil price in yen. They have to essentially try to stop or at least cool off some of the cost push inflation from the importing of energy.
And core prices are around about 4% in Japan, which is double their inflation target.
Right. So let's get into just kind of the near-term dynamics, because it does seem like it's been floated out there that they're going to let rates go higher.
Yeah, I wouldn't necessarily disagree with that, but I'm not going to say it's going to be definitely negative for dollar against the yen, because ultimately they said that over a month ago, and dollar yen has gone one way since then. But I think there is also some concern that perhaps they're worried about money flowing back into yen-denominated assets and that disabling the financial markets. I certainly think that's a valid concern, but I don't think we're there yet. I don't think Japanese investors are going to rotate back into yen on the basis of a tweak to yield curve control, not when US treasuries are basically trading at 5%. That's a 4% interest rate differential. Why would you? I just don't understand that. I think the biggest risk, at the moment, with respect to the bond markets is the record issuance or the issuance of US treasuries to fund all the additional spending that the US government is going to be doing over the next 12 months, whether it be military spending, given what's happening in the Middle East right now, but also the Inflation Reduction Act, which is an oxymoron if I've ever heard one.
And I'm with you 100% on that. So I often see that question posed, who's going to absorb all of this supply, right? And I get it. It's a valid argument. I'm not debating that. My contention would be, the entity, in quotes, that absorbs its supply is, scared out of their mind stock investors, which is the return of the flight to safety dynamic, which is been missing, right? But do you get a
you could see you're right. You could see a flow out of stocks back into bond markets, and with yields at 5%, I think that's certainly a valid argument to make. The bigger question is, how far do you see stock markets falling? I'm looking, say, for example, at the S&P 500, and I can certainly see scope to fall back to around about just below 4,000 on the basis of what we've seen over the course of the past few days. I think one of the things, I was listening to Bloomberg today, are you buying the dip yet? Are you buying the dip yet? We're still in this mindset that we've been in over the course of the past 15 years is every dip you get, you buy the dip. But I'm not convinced about that. Look at the price action on the S&P 500 over the course of the last 4 to 5 months. Lower lows, lower highs. We've broken below the 200-day moving average. The NASDAQ has posted a key reversal pattern. So for me, I think there's more to go on the downside when it comes to US markets. And certainly, I can certainly see 4,000 on the S&P, certainly by the end of this year. That's my end of year target. It has been pretty much since the start of the year. The NASDAQ, on the other hand, what I don't get is why the NASDAQ is as high as it is. Well, actually, I do, because you've got Nvidia, Tesla, and all of those propping it up. But Tesla looks really vulnerable right now. And I think there's potential for that to certainly go back to 160 at least.
What's funny about this buy the dip mentality, it's the media keeps saying, this is actually to what you said about, in quotes, the market. I would go back to what is the market, right? If you look at small caps, they make you lows, right? They're back in COVID territory from 2020. That's the
I noticed that, yes.
Right. So it is interesting that there has been unequivocally a continuation of the bear market in the vast majority of stocks, while the PE expansion has held up the large cap averages. Now, the question, of course, is when does that break, if at all, right? And it's not clear what stops that unless you end up having investors start to say, you know what, maybe those top 7 Magnificent 7 names aren't anywhere near as safe as the U.S. government. And, I always feel like you need to have stabilization of treasuries to get money to come out of, those mega cap names.
Well, look at Nvidia, look at Meta. Nvidia is up 180% year to date. The NASDAQ is up 30% year to date. Now, I know you have to look at that in the context of the declines that we saw last year. But for me, that seems utterly bonkers, if I can use a euphemism that we use here in the UK quite a lot. For me, it doesn't make sense. Meta Platforms, Facebook, again, 152%. Don't get it. You only need to see a big declines on just those two to see a little bit of a meltdown in the NASDAQ. And I see no reason why that can't happen, given what's coming down the pipe right now. Advertising revenues are going to be very vulnerable over the course of the next few months to a slide. We're already seeing it in other areas of the market, particularly here So, for example, in more traditional media companies, TV companies are reporting lower advertising revenues. So at some point, that is going to feed in to Meta. It's going to feed in to Google or Alphabet, as they like to call it. I mean, it's just a stupid name. Google, and companies like that. So for me, I think there's certainly scope for further weakness going forward. That doesn't mean we can't rally from here. The NASDAQ can easily rally back towards 15,000 and it'd still be in the downtrend from the highs that we saw back in July.
That's the other thing that's now being pushed out. I alluded to a little bit earlier in the morning. It's like I'm blown away by how many posts suddenly are talking about positive seasonality, which I guess you can argue is expected, but I see that and it makes my contrarian antennas turn up.
It is a cliche, Michael. I mean, I heard them talking about a Santa rally this morning, and we're not even in November yet. So,
that's like watching all the holiday commercials show up in September for demonstrations.
Well, I think the earliest we saw someone advertising for Christmas over here in August, and it was 35 degrees outside, 35 degrees centigrade, which is about 95 degrees. It's just crazy.
Okay, so currency-wise, a lot of interesting movement. Sounds like we agree that there's some vulnerability, but I would go back to about conditions. So as much as I'm negative, because I think it's pouring outside, doesn't mean it's guaranteed to be a crash, but I have conviction that the conditions are there. Let's talk about the name of the space when rate cuts begin. Now, you've probably seen the same studies I've seen. You should be most worried about markets when the rate cuts begin, despite what the popular narrative seems to say out there. Do you buy higher for longer argument? I mean, I personally don't.
The market currently is buying it, but I suppose it really depends on the central bank. I think the US, I certainly think there is a case for higher for longer. Looking at the US economy, we've got payrolls later this week. The US labor market is still looking fairly resilient, and every single payrolls report this year has beaten expectations. One thing I would say, though, is that the US labor market probably isn't as strong as an awful lot of people think that it is. Yes, the participation rate's going up. Yes, an awful lot of more people are coming back into the workforce. But one thing I took away from the payrolls report last month, Michael, was the fact that 150,000 of those jobs were part-time jobs. They weren't full-time jobs. So you're finding, and I've got a bit of an insight into this because I have family who live in the States, in Ohio, my niece and my goddaughter. She's got 3 jobs just to basically keep a roof over her head. And I think you find an awful lot of people in the US do have more than one job in order to keep, to continue to pay the bills. And I think that is a worry going forward. I think at some point over the course of the next couple of quarters, you will see a sharp slowdown. Will the US economy go into recession? Look, I'm not even going to pretend I know the answer to that question, because ultimately, most of this year, people are predicting the US economy is going to be going into recession, and it hasn't done so. So for me, it's a fool's errand. I think there's a possibility. We heard soft landings, hard landings, no landings. Really, who cares? I think we'll see a slowdown at the beginning of next year. Whether or not the economy falls into contraction, for me, is neither here nor there. It's really about how consumers feel about their finances as to whether or not you see a slowdown. And at the moment, apart from consumer credit in September, which showed a surprise contraction, the US consumer looks fairly resilient, although inflation expectations are rising. So for the Fed, I think they're done, but I don't think they want to admit they're done. ECB, Bank of England, slightly different. I think we're going to get rate cuts in potentially the first quarter of next year from the ECB, because I certainly see evidence that we are starting to see deflation. If you look at the CPI numbers that we saw from Germany this morning, month on month, we saw minus 0.2% in Germany, and it dropped from 4.3% to 3%. So there is significant deflationary forces coming into the European economy. And for all the ECB wants to talk about, there's a prospect of another rate hike. These hawks in Germany, do they really think that more rate hikes are required when the German economy was in contraction in Q3 and inflation is falling off a cliff? If you look at the PPI numbers out of Europe, they've been negative for quite some time. They're turning negative here in the UK, And on that basis, I think that we could see rate cuts from both the Bank of England and the ECB in the first half of next year. I'm slightly more uncertain about the Federal Reserve. It's a bit of a tougher call, given the fiscal stimulus that's being pumped into the economy by the Biden administration. But we don't have that here. And I think that's why we could well see rate cuts in the early part of next year.
Is that unusual historically? That I was always under the impression that the ECB would follow the Fed and be sort of the one to pivot last. Maybe I'm wrong with that thinking.
No, to be quite honest, I don't. I think they'll have to pivot irrespective of what the Fed does, on the basis that the rates currently that is being seen in Southern Europe are killing them. Italy has to refinance an awful lot of debt over the course of the next 6 months, and they don't want to have to be refinancing it at 4 or 5%. The debt to GDP ratio is already 140% of GDP, and 2 years ago it was 120%. The Maloney government is already pushing back hard on further rate hikes. They criticised the last one. I can't believe they actually raised rates at the September meeting. That just made no sense to me whatsoever. I called that wrong. I thought they'd hold. I thought the Bank of England would hold, but I didn't think the ECB would raise. So, on that basis, I think that they will be forced to, because otherwise they could have a sovereign debt funding crisis.
But that could be a real problem, I would think, in terms of just what the Fed does next, right? I mean, that would have the effect of strengthening the dollar on a relative basis even further.
Yeah, it would. Yeah, it would. And that's why I think euro dollar will probably go through 105 and down towards 102, and there'll be nothing the Fed can do about that. And to my mind, I don't think the Fed cares. I mean, the Fed has never cared about a strong dollar. It didn't care in the 2010s, 2011s, 2012s when, the dollar went soaring, and I don't think it will, or even a weaker dollar. The Fed will do what's best for the US economy. Always has, always will.
But I guess the question becomes if the stronger dollar, and granted this is in euro terms, but if the stronger dollar has implications on other sovereign emerging economies, sovereign debt risk, right? Then the Fed would care.
It might, yeah, it might. I'm guessing you're talking more emerging market
exactly
economies,
right. But there's a risk there.
But there is absolutely a risk, and I think obviously if we did see that, then the Fed would act. But at the moment, we've seen 14 rate hikes in the course of the past 12 to 15 months, and apart from the regional banking crisis in March, the markets have held up reasonably well. And I think we'd have to get really bad for the Fed to resile from its current policy of higher for longer. I mean, let's not forget, they've still got another rate hike in their dot plots, 6% for the end of this year. And for next year, they raised it to 5.1. It'll be very interesting to see what Powell has to say on Wednesday about whether or not they're leaning in the direction of changing those projections. Obviously, they won't. They won't do that until the December decision. But for me, I thought it was very interesting that he raised the 2024 from 4.6 to 5.1. And, on that basis, I don't think they'll want to lean into making the market think that they will cut rates by more than, say, for example, 50 basis points next year, or 25, as it is at the moment.
Going back to Europe, I often don't talk about Europe too much on these spaces, but I think it's important to get that perspective. Are there pockets of opportunity, some European countries that look really undervalued, independent of the broader deflation risk, or is it still kind of broadly a basket case?
I hesitate to use the word basket case, but certain markets in Europe are, I would argue, slightly vulnerable to a correction. The FTSE MIB being a case in point, that's done reasonably well over the course of the past 2 years. But the Maloney government hasn't really been tested when it comes to the fiscal rules that Brussels insists or imposes on its more vulnerable economies. And I think for me, the situation in Europe needs to get an awful lot worse than it is right now. And if you look at the PMIs in Spain and Italy, they're actually holding up fairly well. It's really France and Germany that are struggling. And obviously we've got French GDP this week. We've got Italian GDP this week. And I think the big question will be when we look at the December rate decision from the ECB is how they pitch their future interest rate decisions against an economy in Europe, which is going to look an awful lot worse then than it is now. So for me, on valuations alone, Europe is a hell of a lot cheaper than, say, for example, the US. So I'd feel more comfortable buying Europe, but you've got to be very selective in terms of the companies that you invest in. It's not as simple as buying a tracker and then just basically holding on. You look at the FTSE 100 again, that's down on the year. And I thought that would go to 8,000 and stay there this year. That hasn't happened. And unfortunately, I think over the course of the next 3 to 6 months, it's going to be very difficult to arrive at a decision that suggests that you'd want to be long of any stock market. But if you pointed a gun to my head and said, where would you want to be invested in the slightly longer term, in the next 3 to 6 months, I think Europe and the UK will probably outperform the US. But then again, I said that at the beginning of this year, and look how that turned out.
I've seen some charts that show that credit spreads are widening in the Eurozone broadly. And, in the US, obviously, it's still fairly tight. Let's talk about that, because you are starting to see default risk getting priced into some of these issuers.
I don't think we're going to see any defaults, because ultimately I think what will happen is that central bank, and this is essentially, I think, why we'll see rate cuts from the likes of the ECB in the first part of next year. We're not at a tipping point yet for Europe. We're not. But we could get there over the course of the next 3 to 6 months. And I think that's what I'm very painfully aware of. 10 years ago, actually I think it was longer than that, and the Eurozone debt crisis. The ECB was virtually staring down the barrel before it actually did anything. And again, Brussels, staring down the barrel before they actually did anything. And ultimately, that's probably what is going to have to happen over the course of the next year or two to prevent a similar scenario playing out. You remember the speech that Draghi made in London? Whatever it takes. We may need something similar along those lines if we get a similar sort of scenario play out.
Please make sure you follow Michael here on X. If you want to come up and ask questions, click that bottom left mic request button. And as always, this will be in podcast under Lead Lag Live. You has mentioned consumers are, seemingly resilient in the US. I tend to push back on that only because I look at, consumer sensitive stocks, retailers in particular. They're just like small caps, and making fairly poor performance on the charts. What about consumers in Europe broadly? Again, I know there's distinctions across different countries, but what's the there?
They're struggling. They're struggling very much so. You're in the US, you're in the nice position, and I use the term nice in inverted commas, of having your own energy resources, natural gas, shale oil, shale gas, which has essentially kept energy costs lower. Whenever I've been to the States, I've always had a wry smile when you guys complain about $4 a gallon, which I think is highly amusing. I'd love to pay $4 a gallon for a tank of gas. I really would. It's over double here in the UK. So, for me, I think living in a country where you have your own energy resources, I think you are a little bit spoiled. Having said that, and that's why I think US consumers are in a slightly better place. I do understand, Michael, that you look at a much bigger cohort of US stocks than I do. I look at the players like Amazon and Walmart and Target and companies like that. So it gives you obviously have a much better, overview of the US. But here in the UK, it's a similar sort of story. You've got the retailers who are actually doing very well. Companies here in the UK like Marks and Spencer's and Next, who've had fairly decent share price performance so far this year and are actually managing to shift goods. But then on the flip side, you've got companies that are struggling, the online retailers, the ones that did really well during the pandemic, who've basically lost about 80 to 90% of their value, their market cap from the peaks back in 2020. So you've got a very much a two-tier retail market, the companies that have been able to adapt to the changing environment and the companies that haven't and have gone bust. And we've had a number of retailers go bust this year that weren't able to adapt their business model to a much different retail environment. The first half of this year fairly positive here in the UK for consumers. But you have to remember that food price inflation here is still 10% per annum, which is quite a bit lower than what it was at the beginning of the year, which was around about 22. And energy prices are still an awful lot higher than they were 2 years ago. And wages haven't in any way kept in touch with them. So you've got very much a two-tier market. Consumers are spending more in terms of price, but in terms of volume, they're not buying anywhere near as much. And it really depends on the data point that you look at. But in the second half of this year, I will be surprised if the UK economy doesn't slip into a technical recession. And as for Europe, I think they're probably already there or on the way there. So it's going to be very difficult given how much higher energy prices here in the UK and Europe are relative to the US. And it means that essentially consumers have much less money. And also the mortgage market here in the UK is different, Michael, very different, because an awful lot of people fixed at zero interest rates. And unlike the US, whereby you can get a fix for the whole 30-year term, you can only get 2 or 5 year fixes here in the UK, which means an awful lot of those 2 and 5 year fixes are now rolling off now, which means an awful lot of mortgage holders are having to refinance from, say, 1 or 2% to now 5 or 6%. And that's a huge chunk of change coming out of your monthly income and energy prices that are over double what they were 2 years ago. So against that backdrop, it's going to be very difficult, even with wage growth trending at 7.8%.
So you mentioned 30 years of experience on the trading side, which of course means you've seen all kinds of geopolitical dynamics. From a trading trader perspective, obviously, aside from the horrible nature of what's going on with Israel and Palestine, is there anything that you have done differently or that you've thought about in different ways given the war? Or is it more just something that, again, is horrible, but is not really impacting markets?
It's not impacting markets from the FX side of it as much as I thought that it would. I think what we're seeing in bond markets, I've never seen before. And I'm just glad I'm not a bond trader, because I think I'd struggle with the amount of volatility that bond markets have been seeing. And I think that worries me a little bit. And the disconnect that we're seeing in some of the markets is becoming an awful lot more difficult to basically try and predict what's going to happen in, say, stock markets relative to bond markets. And it makes the intermarket analysis that much more difficult going forward. So for me, I think it's made me slightly more cautious about some of the trades that I put on. And it's something that I've always said to our clients. Don't feel the need to trade just for the sake of trading. Wait for the market to come to you, because there'll always be another opportunity. You know, not having a position is just as valid a position to have as to being long as to being short. Some of the best decisions I've made have been not trading as opposed to trading, because it's actually saved me some money. So it's made me slightly more cautious, but it's also made me an awful lot more aware that you need risk management, proper risk management, and you need to be disciplined when it comes to any trading decisions that you make in these markets, because they will kill you.
By the way, that pain you reference being a bond trader, I feel that acutely. So it's been a hell of a ride the last 2 years. But let's talk about the sort of trading approach and strategy that you do. You said something which is interesting. You said stop loss, but there isn't that much focus on when to take profit. So I think it's interesting to frame it that way, because the one thing you often hear about good traders is that they let their winners run.
Yeah, but they also take profit. They don't allow the market to come back and wipe out their entire profit. And this is a conversation that I've consistently had with many of our clients. They take the right decision in terms of entering a trade. They get the stop loss position right, the trigger point right. What they don't do is they don't trail the stop loss up behind the market as it goes. Now, obviously, the downside to that is you can actually get taken out on a spike down or a spike up and taken out prematurely. For me, that's always going to be a risk. Run your winners by all means, but trail your stop loss up at a healthy distance behind it, so you then don't give back all of your profits on a profitable trade. And that's why I always look at trends, because trends can give you I'm looking at the US 10-year yield right now, And yeah, it's whippy, but there's a clearly definable trend through those lows from back in April, May this year. You can draw a line right through it. So, I mean, obviously, I'm not suggesting that, anyone's doing anything right or doing anything wrong. But if you've got a clearly defined trend there, why not basically just run it higher with a stop loss below the trend line? And that way you stay in it for longer.
But I think it's, correct me if I'm wrong on this, I think it's fair to say that there's some asset classes where trailing stops, tend to be more.
Just don't work.
Right,
Yeah.
exactly right.
Yeah.
Where those gap
Yeah.
is what you kind of alluded to,
Yeah.
right? So in currencies, like, clearly you can have it, you're less likely to have one of those sudden, aggressive moves out of nowhere.
Yeah,
Same
because
with bonds.
obviously it's a 24-hour market.
Right.
So the liquidity is, which is why I like FX. But it also means one of the things you asked me about adapting my trading style, Michael. I don't run anything over a weekend anymore. Now, I used to do that a lot, but now I don't because of the gaps that happen on a Sunday night. And the one thing that really, I think, stopped me cold on that was when there was a flash crash in cable in October 2017, 2018?
Yes, I remember that vaguely. Yeah.
Yeah. And I mean, I had something in cable. Fortunately, I was the right way round, not the wrong way round. But it stopped me cold. And I thought there's absolutely no benefit to running anything over a weekend, particularly when trading is that thin on a Sunday night. Because for every one you get right, the one you get wrong will wipe your book out.
Do you feel like is that a new dynamic? I mean, or is it just function of there's so much more debt in the system that these tail events just kind of seemingly come out of nowhere, where technology is so fast?
I think it's a combination of the two. Obviously, technology has something to do with it, but if the liquidity is not there, the liquidity is not there. And I think one of the things you have noticed is that we have seen an awful lot of these high volatility events. I mean, the Euro Swiss was another one when the SMB dropped the peg. I mean, I still get cold sweats about that even now. And I think they're becoming more and more common. Having said that, we haven't seen one recently on FX. And I think that is a concern because I think it will make currency traders slightly complacent. But I always say to people, when I do my monthly webinar on non-farm payrolls, I tell our clients, when you put a trade on this afternoon, just make sure that you don't have to run it over the weekend because otherwise you could be chewing your fingernails between Friday close and Sunday open in the event that you get some news out, particularly now with all the geopolitics that's going on in the Middle East and obviously Ukraine, which no one is talking about anymore. It is a real risk because it doesn't matter whether you have a guaranteed stop loss, and an awful lot of these companies do offer them. But ultimately, there's always a caveat, and you always have to pay slightly extra for a guaranteed stop loss anyway. So you have to then balance up whether or not it's worth having that guarantee over the course of a weekend. And for me, I just don't think it's worth it. And if I don't think it's worth it, and I've been, sort of monitoring FX markets for 30 years, then why do you think it's worth it when you've been trading it for even less than half that?
Anything on the yuan as it relates to currency markets? Because I feel like nobody's talking about China and how it could move with currency too.
Yeah, I mean, I don't really look at it because we don't have it on our platform and our people don't trade it that much. But I think one of the things I have noticed about it is how it's almost trading in line with the yen. And that's not to say that it can't get any weaker. I think there is a possibility that we could see a further easing of policy from China. But even if they do, the economy there is in deflation as well. The PPI is negative 2.5%. CPI is flat. So that's another potential deflationary, stagflationary impulse that's pushing out through the global economy. So again, it feeds into my narrative that we could see rate cuts from ECB and, the Bank of England and potentially the Fed towards the end of next year.
Talk about the CMC itself, the company. What do you guys do? What kind of clients do you have?
Varies. I mean, basically CFDs, contracts for difference, spread betting, leverage trading. A lot of our clients are what I would call premium clients. That's essentially our main revenue earner, if you like. We have a big retail audience, big retail clients. So, you can trade on an asset or a company or a for £1 a point. But obviously the downside to that is you can lose a hell of a lot more than £1 if the market goes against you because of the leverage. So I think for me, one of my key roles is not so much educating our more experienced clients, our alpha clients, our premium clients, as we call them. It's keeping our more retail audience, whose account size generally tends to be about £5,000 or £10,000, keeping them in the game. It's about capital preservation first, risk management, and capital appreciation second, because you keep those clients on board, they'll keep coming back and trading. So for me, it's about education. 67% of retail clients actually lose money spread betting or trading CFDs. And it's my role to get that number down from, the low 60s, 50s, or what have you. A year ago, it was around about 77. So the vast majority of people don't make money trading CFDs and spread betting. And, as I say, my key role is to educate the clients, tell them what's going on, keep them informed, and hopefully educate them that trading financial markets can be fun, lucrative, but ultimately they need to be very careful about how they manage their risk.
I don't know if you've seen the aggregate data on it, but every now and then you'll have some brokerage platforms, talk about, this is where most of their retail clients are positioned, and oftentimes it ends up being a contrarian signal. Is there any kind of overwhelming type of allocation or trade that most of the retail clients that you're seeing are putting on?
Yeah, I mean, most clients like being short. So when the markets are going up, it's very difficult to talk them out of that mindset. But the most popular assets for us, from our perspective, are US equities. So you're looking at Tesla, you're looking at Nvidia, you're looking at Microsoft, Apple, Amazon, the NASDAQ 100, S&P 500. They love being long of the individual stocks, but they hedge by being short the index, which isn't necessarily the best place to be. So when markets are falling, they generally tend to do better because generally they tend to be net short on the underlying index. And this is why I think this week is going to be very key when it comes to where markets go to next. Obviously, we've got the Fed, we've got the Bank of England, we've got non-farm payrolls, we've got ADP, we've got ISM, we've got a whole host of stuff. And obviously, we've got Apple's latest results. But from what I've seen over the course of this week, our clients are in a fairly decent position-wise if the markets continue to look vulnerable. If we suddenly see a spike higher, well, that could be tricky.
I got to use that line. It's just ended like that. Well, yeah, that's not going to be a good thing. But although it is interesting that it does reaffirm the idea, just given the global perspective, that the Magnificent Seven phenomenon is not just being driven by U.S. money.
It's not. Absolutely not. I can, definitely say that is a fact. It's very much. And it's not hard to see why. These companies are very liquid. The spreads are tight. People love trading them. They move around. Volatility is good. What's not to like? And they generally tend to be fairly forgiving on a day-by-day basis. But when they move, God, they move.
What's, just given the nature of the retail phenomenon post-COVID, do you find that most newer traders are, as they enter, more sophisticated than newer traders of the past, or maybe have even more wrong conceptions around how to trade, just give misinformation around social media and what works and what doesn't?
I think there's a little bit of overconfidence there. I also think they tend to latch on to an indicator that they've heard an awful lot about. And say, oh, yes, case in point is MACD. Oh, how does MACD work? I really want to use MACD because I've heard that it does really well. And my view is, don't obsess about MACD. I said MACD is a trend following indicator. If you in a range bound market, it will kill you. You'll end up buying at the top, selling at the bottom, and you'll blow your account up. I said, stick to the basics, understand the basics. So many people, new entrants, don't understand the basics. They've heard about this new indicator that's trending on social media, and you get a whole host of snake oil salesmen trying to sell them the benefits of this new trading system. It's nonsense, right? There's no substitute for grounding yourselves in the mechanics of the markets and how prices move. I'm still learning now, 30 years. I don't believe for one moment that I have it sussed. I really don't. You got to be open to being wrong. You got to admit when you're wrong, get out, and then reassess going forward. You will never go poor by basically taking a loss on the chin. There's no shame in it. And an awful lot of people come in and they have overinflated expectations of their own ability. And very soon they run amok. One thing that I have noticed since COVID is that obviously an awful lot of those retail traders that came in during COVID and the GameStop and all of that sort of stuff have found out to their cost that financial markets aren't as easy as perhaps they first thought. You can have something which I call beginner's luck and you can do very well in the short to medium term. But unless you learn very quickly that sometimes markets can go in the opposite direction, then you will find that that account that you built up will disappear even quicker than when you took to build it up.
Mike, for those who want to track more of your thoughts, more of your work, where would you point them to?
My work, follow me on social media, Twitter, X, or as it's called. Everything that I basically post goes on my social media account. There's also CMC Markets website, cmcmarkets.com. In the learning section, there's a whole host of information there that you can find about webinars and events, news and analysis from not just me, but our analysts in New Zealand and analysts also in Germany and the rest of Europe.
Everybody, please give a follow to Michael here. Again, this will be podcast under Lead Lag Live in a couple of days, and hopefully I will see you all later in the week. We've got a few more of these spaces, conversations lined up. Mike, really appreciated the perspective you bring. I think was really important for the audience here.
Thank you for inviting me on, Michael. It's been a pleasure.
Thank you, everybody. Cheers.